Welcome back to the Deep Dive. Today we're digging into the financials for Solar Industries India Ltd, SIAL. We're looking at their Q2 and half-year results, ending September 30, 2025.
Right.
Now, earnings reports can seem, well, dry, but this isn't just about the numbers. It's about uncovering a really significant strategic shift that lets SIAL do something quite remarkable.
Exactly. And for this, we've got a solid base. We're drawing from the official filings to the NSE and BSE from November 10th, the company's press release, their investor slides, and, crucially, the full conference call with the CEO, Mr. Manish Newall.
Okay, so here's the core thing, the mission for this deep dive. SIAL reported highest ever quarterly results, record revenue, record profit, the works. But, and this is the interesting part, Mr. Newell himself talked quite a bit about serious headwinds in the domestic market. So that's the puzzle we need to figure out for you. How did they hit these records when key local sectors were, well, sluggish? Okay, let's unpack this.
It really is a fascinating case study in diversification, and you can see the scale of what they achieved right away in the Q2 numbers for FY26. Compared to last year, it was genuinely a record quarter.
So give us the scorecard. What are we looking at?
Okay. Net revenue climbed to 2082 crore. That's a solid 21% jump.
Wow.
Yeah. Then EBITDA, the core earnings, hit 582 crore, up 23%. And the bottom line, profit after tax, or PAT, reached 361 crore. That's up 19% year over year. Impressive stuff.
Those are strong numbers, especially, like you said, given those headwinds. What about the first half of the year? Does the picture hold?
It does. Looking at the full H1 FY26, the trend is consistent. Net revenue grew 25% compared to H1 last year, reaching 237 crore. Wow. Half-year EBITDA was 1,146 crore, and PAT came in at the 714 crore. And importantly, their consolidated EBITDA margin for Q2 stayed really healthy at 27.95%.
Right, so they're not just chasing volume, they're keeping that efficiency.
Precisely. It shows they're maintaining profitability even as they grow.
Margin strength is key, yeah. But the real foundation, the thing that should really grab your attention if you're following this company, has to be the total order book.
Absolutely. That's the bedrock. The total order book now stands at over 17,100 crore rupees plus.
17,000 crore plus.
Yeah. This massive backlog isn't just numbers on a page. It's why management sounds so confident about hitting their full-year guidance for FY26. It gives them visibility for quite some time.
Okay, and this is where, for me, it gets really interesting, because those record numbers, that huge order book, they point straight at one thing, the defense business. It feels like it's gone from being a side gig to the main engine.
That's exactly the story the data tells. I mean, look at Q2. Defense revenue alone crossed 500 crore.
₹500 million in one quarter.
Just from defense. That's a massive 57% year-on-year growth in just that segment. And for the full first half, defense revenue topped 900 crore. That's a 79% jump compared to H1 last year.
79%. So how does that change the overall business mix?
It fundamentally shifts the balance. The defense segment's contribution to their total consolidated sales. It jumped from 19% in Q2 last year up to 24% this quarter.
Wow, that's a big swing.
It is. That 5-point shift signifies, they're not just an explosives company doing a bit of defense work anymore. They're really becoming a strategic defense player that also serves the mining sector. It's a different profile.
That feels like a tectonic shift, as you say.
Yeah.
So looking ahead, what specific projects are underpinning this new growth phase management keeps talking about?
Right. Well, the defense order book makes up the lion's share of that total backlog we mentioned. It's over 15,500 crore rupees.
Just defense.
Just defense. And management specifically pointed to Q3 as the start of this new growth phase, driven by the beginning of commercial sales for the Pinaka rockets.
Okay, for listeners maybe not deep into military tech, what exactly is Pinaka?
So Pinaka is India's main multi-barrel rocket launcher system. It's a really important high-value indigenous program. Delivering on this means LAC is moving way beyond just making the explosive bits. They're becoming a key system integrator.
Okay.
Their ambition is clear. They want to cross the 1,000 crore mark from defense soon. And they've set this incredibly ambitious annual guidance of 3,000 crore rupees just from defense for the full FY26.
3,000 crore from defense for the year. That's huge. Is that realistic, though? I mean, given defense project timelines and supply chains, is it all riding on Pinaka, or is there more backing that up?
That's the critical question, isn't it? And the management commentary suggests it's not just Pinaka. They're diversifying within defense. They confirm, for instance, that trial production for 155mm shells has started,
Right.
and they expect commercial production to kick off in Q4. Those are, standard high-volume ammunition types used globally.
And they're also pushing their own indigenous tech, aren't they? That suggests deeper partnerships.
Exactly. They specifically mention getting repeat orders for their loitering munitions. Think of those as sort of one-way attack drones. And they highlighted the ongoing development of the Barser counter-drone system. That's a particularly interesting one.
What's significant about Barser?
Well, the sources describe it as a hard kill solution. Now, most counter-drone systems are soft kill. They use jamming or hacking. Hard kill, like Barasur aims to be, physically takes out the drone, maybe with projectiles or explosives.
Okay. Direct interception.
Right. It's a capability that's increasingly critical, and management expects the field trials for Barasur to wrap up by March 2026. So it shows they're really investing in cutting-edge, potentially high-margin stuff that aligns with national strategic needs.
So while domestic defense is clearly the big story, we need to talk about the international side too. They seem to be positioning themselves as a global supply chain partner, not just India-focused.
That's the other key pillar, geographic de-risking. Their international business also had its highest ever quarterly sales, bringing in over 960 crore in Q2. That stability meant international markets accounted for, 46% of their total consolidated revenue in the quarter? That's almost half. It acts as a really important buffer against any slowdowns in one particular region, like the domestic one they faced.
And where is that international growth coming from specifically? Which regions?
Currently, the strong performers driving that growth were places like South Africa, Turkey, Ghana, Nigeria, and Tanzania. Looking ahead, say, the next 6-12 months, they're focused on getting facilities operational in Australia and Kazakhstan. And they're also trying to break into the Saudi Arabian market, which is, potentially very lucrative, but also complex.
I thought the global context they gave was interesting too. Management didn't shy away from saying they're benefiting from wider geopolitical stuff.
They didn't. They explicitly said they see definite shortages in the global ammunition market right now. And the numbers really support that idea that they're capitalizing on global friction. About 8,000 crore rupees of that huge defense order book, that's from international customers.
8,000 crore in export orders. They're becoming a major exporter then.
A very significant one, yes.
And talking about managing global risks.
Yeah.
You flagged a technical accounting detail in AS29. Can you break that down simply for us?
Sure. And AS29 is basically the accounting rule for dealing with hyperinflationary economies. Think extreme inflation, currency volatility. They applied this rule to their subsidiaries in Turkey.
Okay.
What it signals, really, is that they're acknowledging and actively managing the financial risks that come with operating in these high-growth but very volatile markets like Turkey. They're not burying their heads in the sand. They're accounting for it properly and transparently.
Okay, right. So now we have to circle back to that paradox we started with. All this record performance, the defense boom, the global success, it happened despite the domestic issues.
Right.
What exactly was that domestic headwind?
Yeah, the CEO was very direct about this. The main culprit was the unusually heavy and prolonged monsoon season. The rain. When you have that much rain for that long, it leads to a considerable drop in coal mining activities. And remember, explosives for mining and infrastructure are their traditional core business. You just can't do large-scale blasting safely in those conditions.
Okay. So the weather directly hit their bread and butter business.
Yeah.
How much did that show up in their sales mix?
It was noticeable. Their business from Coal India, CIL, dropped from contributing 10% of sales in Q2 last year down to 8% this Q2. And similarly, the housing and infrastructure segment fell from 11% down to 8%. Those are pretty significant dips in their legacy areas.
Right.
The silver lining is that management fully expects demand from both coal and infrastructure to surge back in Q3 and Q4 now that the monsoon season is over and projects can restart.
Okay, that makes sense. But if the monsoons were slowing down the traditional business, and at the same time they were trying to ramp up this huge complex defense production, did that create any sort of financial strain in the short term?
It absolutely did, and this is where you see the operational trade-offs. This big strategic pivot definitely caused a short-term squeeze on cash flow. Their operating cash flow, OCF, for the first half of FY26, it dropped dramatically by more than 80% compared to H1 last year.
80% drop in OCF. That sounds quite alarming.
Yeah.
Is that a failure, or is it just, the cost of shifting gears so drastically?
It's largely the cost of that transition. You see, they're essentially spending money faster than they're collecting it right now. They're building up huge inventories, raw materials, components for all those rockets and shells, but they often can't build a customer until final delivery and acceptance, which takes time in defense.
Right.
So that OCF drop is the direct result of moving from supplying mining explosives, which usually has a pretty quick payment cycle, to becoming a major defense contractor with much longer lead times and bigger upfront investments.
So it's a necessary pain for the long-term gain they're targeting.
Mm-hmm.
What did management say about getting that cash cycle back on track?
They sounded confident. They reiterated their target is to get the working capital cycle back down to around 90 days by March 2026. They expect the cash to start flowing much better in Q3 and Q4 as these big defense deliveries happen and they collect payments.
Okay.
And interestingly, they also mentioned their big capex plan, capital expenditure of 2,500 crore for FY26. Even that is facing a little bit of deferment, partly because those same heavy monsoons physically slowed down construction and asset creation work. It just reinforces that the weather impact was real and broad across their domestic ops.
Okay. So if we pull back and summarize this whole deep dive, the main story for you, the listener, is really one of resilience, isn't it? These record numbers weren't achieved easily. It was through deliberate strategic diversification, managing to mask some of those domestic weaknesses, and this really massive successful pivot into defense.
That sums it up well. The strong H1 performance is basically down to their defense backlog and their international strength offsetting those temporary operational issues and the genuine slowdown in the legacy mining and infra segments. It shows their diversification strategy isn't just on paper. It's actually working as a robust, adaptive business model in what's clearly a volatile world. So yeah, what does this all mean for you?
Well, I think it means that while SILE is clearly focused on delivering critical stuff for India's own defense, like the Pinaka rockets, the Bharat system, you can't ignore their massive commitment to the global ammunition market. That 8,000 crore rupees in international defense orders, that's huge. It's just the geopolitical friction management mentioned isn't just a backdrop. It's creating a massive, ongoing export opportunity that SILE seems uniquely positioned to capture right now.
Good point.
So the final thought to leave you with is this. What are the long-term implications for a company that can successfully juggle serving its own country's strategic needs while also becoming a major supplier to meet this huge global demand for defense materials? It arguably creates a really solid multi-year revenue base that's far less tied to the ups and downs of things like coal mining or local infrastructure spending, something to consider.